Hi everyone! The US stock market ended the week, the month and the first half of the year with an explosive rally in key indicators. The Nasdaq Composite jumped by 31.7% since the start of 2023, marking its best first half performance since 1983. Now the question is whether the rally will continue. Investors have taken stock and are preparing for a new week, month and half-year period. The market has kicked off the new week on a sluggish note due to the Independence Day holiday in the US on July 4th. However, you must remain focused as the final data on the US labor market will be released at the end of the week. Thus, market volatility may increase. From a technical point of view, the upside momentum seems to be fizzling out as the general pessimism eases. However, there is a likelihood that fundamental factors will encourage macroeconomic indicators will support the market. Before the US reports data on non-farm payrolls, market participants will be digesting their minutes from the latest FOMC meeting scheduled for Wednesday. Traders will probably receive some clues about the future of the Fed's monetary policy. Notably, Jerome Powell said last week that the regulator would continue to raise interest rates in 2023. So stay with us, watch the video till the end and share your thoughts on the US economic and monetary policy. Although the market has ended the first half of the year with strong gains, uncertainty remains. Investors are still wondering when the recession will come, how quickly inflation will ease, and if the rally will continue. Well, the US economy has proven resilient in the face of the Fed's aggressive monetary tightening, avoiding a recession, whereas many experts predicted an economic downturn in early 2023. The scenario suggesting a recession this year is seen as a less likely one, but economic fears persist. A New York Fed model projects a 71% chance of recession in the next 12 months. Market participants do not believe it yet, but the market outlook may well turn negative if statistics on inflation and jobs are gloomy. The annual inflation rate has halved since reaching a 40-year high last summer, yet it remains well above the 2% level the Fed would like to see before it begins to pause its monetary policy tightening. The US Central Bank is expected to raise rates again in July, with markets betting on 2 more rate hikes this year. Earlier in the week, Goldman economists lowered their inflation forecast for the year. It now stands at 3.5%, down 0.2 percentage points from the earlier projection. They expect inflation to decline at a faster than anticipated rate, giving the Fed some breathing room. As for the rally, several large companies such as Apple and Nvidia are driving the S&P higher, sparking fears that it could be unsustainable if more stocks do not join. While the S&P index has added 14% this year, the equal weight version of the index, a measure of average stock prices, has been up by just 4.2%. The spread between the two indices is at levels last seen during the dot-com bubble. The theme of artificial intelligence remains dominant. Excitement over advances in this sphere has helped push stocks higher and boosted earnings estimates. In the coming weeks, investors will follow second quarter results to clarify how soon companies expect to reap financial benefits. The weak spot is the banking sector following the crisis caused by the Silicon Valley Bank's failure in March, even though stress tests have been successful. And now let's move on to the indices. The Dow Jones Industrial Average has kicked off the new week in positive territory, again recording gain of 3.8% for the first half of the year. The good news keeps coming. Inflation expectations for the next year dropped to 3.3%, the lowest level since March 2021. Meanwhile, consumer sentiment rose more than expected, according to the University of Michigan's survey. Much depends on the June jobs report scheduled for Friday. It should show that the labor market is weakening just enough not to add to inflationary pressures, but still tight enough that unemployment will not rise sharply. In this case, the second half of the year will start as well as the first half ended. Notably, Monday's data showed that manufacturing activity in the U.S. slumped to the lowest level in nearly 3 years. The ISM manufacturing PMI fell to 46 in June 2023 from 46.9 in May, below forecasts of 47. However, the news went unnoticed by traders, perhaps due to the shortened trading day ahead of the Independence Day holiday, or investors waiting for more significant data to be released this week. Consensus estimates indicate that the high employment rate is likely to persist despite decreasing slightly compared to the previous month. The U.S. economy is projected to add 200,000 new jobs compared to 339,000 in May. Unemployment is expected to remain at 3.7%. Earlier, the unemployment rate hit 3.4%, the lowest level in 53 years. Many analysts believe that investors should prepare for a new surge of volatility in July, which has historically been a strong month for the stock market. Since 1990, the S&P has risen by 1% on average in July. The index has had quite a spectacular performance so far compared to the Dow Jones. The S&P added about 5% in June and jumped by almost 16% in the first 6 months of 2023, achieving its best half-year performance since 2019. Most analysts are bullish on the stock market, with one outlook raising the year-end S&P price target to 4,825 from 4,750. This optimistic forecast would represent potential gains of 8% from Friday's close at 4,450. The index's current all-time high is 4,821. An outlook by CNBC strategists expect the S&P to hit 4,227 by the end of 2023. The index's current short-term target is the range between 4,550 and 4,600. A bullish rally is on the horizon, fueled by hype surrounding generative artificial intelligence technologies. This popularity is not just a brief trend or a fad. This is the beginning of the fourth industrial revolution, a world-changing event. At the forefront of this breakthrough is NVIDIA. The famous US chipmaker produces graphics processing units used for both video games and artificial intelligence development. The company's hardware powers the technology behind such chatbots as ChatGPT and Google Bard. NVIDIA projects its second quarter sales to hit $11 billion, greatly surpassing Wall Street's forecasts of $7.15 billion by 50%. Furthermore, the company expects its revenues to increase by 33% year over year. If this outlook is realized, it could propel NVIDIA towards becoming the most valuable company in the world. Meanwhile, the Nasdaq Composite has also advanced significantly over the past 6 months. The index jumped by 31.7%, its best first half since 1983. This increase can be attributed to base effect. Last year, the Nasdaq plummeted by 33.1%. Nevertheless, the incredible rally of the Nasdaq should not be overlooked. In some ways, this year has been more impressive for stocks than the previous year. Inflation is coming down. The May PCE price index showed that key components are declining, albeit more slowly than everyone had hoped. Interest rates are at their highest level in 16 years after hitting that level in just 10 months. The high Fed funds rate has already wiped out 3 regional banks in March and 1 in May. Nevertheless, tech stocks, which tend to be particularly sensitive to borrowing costs, are still going strong. The market capitalization of Apple rose by 2.3% as of Friday and surpassed the $3 trillion mark, making Apple the first publicly traded company in the world to reach that level. The stability of Apple stocks certainly deserves praise and attention. Analysts suggest that Apple's market value could rise to $4 trillion by 2025, a 25% increase from current levels. Shares of Apple have risen steadily during the year, gaining about 46% in the first half of 2023. Investors saw big tech securities as safe haven assets during periods of rising economic risk and uncertainty. In other news this week, Tesla's strong car deliveries data, which came out over the weekend, attracted the attention of investors. The second quarter was a remarkable period for Tesla. The company's worldwide electric vehicle shipments rose by a record 83%, thanks to significant price reductions and rebates. Under the leadership of the world's richest man, Elon Musk, the electric vehicle manufacturer reported astronomical sales of more than 466,000 vehicles from April through June. However, shares of Tesla fell by 10% in April following the release of disappointing first quarter earnings, which were lower than expected due to reduced prices of electric cars. Musk reiterated Tesla's willingness to accept lower profits if it would help the company increase its market share. The impact of this sales growth strategy on Tesla's earnings will become clear on July 19th, when the company releases its financial results for the second quarter. Analysts believe the company's stock is at some kind of inflection point right now, and that bullish traders should keep an eye on it. On Monday, shares of Tesla rose by almost 7%, and they are expected to climb even higher in the future. Tesla is at a major turning point right now, but Wall Street, for some reason, does not have enough confidence in its artificial intelligence tech. And we continue to monitor the situation to keep you updated. Stay tuned and subscribe to our channel. See you next time.